Kia ora, and welcome to the CoreLogic Property Market Update for Haratua, May 2023. Property values continue to fall in Aotearoa, with the CoreLogic House Price Index down 0.6% on the latest monthly reading for April. However, given this was a smaller fall than previous months, it suggests an easing of the current downturn and possible end in sight. This is especially true when delving beneath the surface of the national figure, with some areas, including Tamaki Makaurau, Auckland City, Ahuriri, Napier, Te Awa Kairangi ki Uta, Upper Hutt, and Te Whanganui Atara, Wellington, all registering minor increases in value over the month. We know that 1 month does not make a trend though, and even in these areas it's too soon to call the market trough. But the evidence is starting to mount in favour of it not being too far away. Broader context also puts the recent figures into perspective. For example, the 0.2% increase in Te Whanganui Atara, Wellington City, is dwarfed by the annual fall of 18.7%, and is minor even compared to the 2.4% decline witnessed over the last 3 months. Interestingly, Ngā Motu, New Plymouth, was one of the worst performing main urban areas over the month, seeing values fall 1.2%. However, the annual rate of change, sitting at negative 5.4%, puts it into one of the better performing areas over that period, behind only the gravity-defying Tahuna, Queenstown market, where the average value sits 0.1% higher than it did a year ago. One factor that could play into the potential near-term end of the nationwide downturn is the weakness in number of properties being listed for sale, which has tracked consistently below the previous years. 2 points on this. There's clearly no rush to the exits for current homeowners or investors needing to sell their value-reducing asset. But also, it's leading to a reduction in overall supply, as properties either sell or are pulled off the market. With the total number of properties listed for sale gradually reducing, any increase in demand could place upwards pressure on competition, and competitive markets generally lead to higher prices, especially in the housing market. Speaking of demand, a few recent changes and announcements might provide a small boost throughout the rest of this year, namely the loosening of the Credit Contracts and Consumer Finance Act in early May to improve borrower capacity to service lending should allow a few more creditworthy borrowers to become active, while the proposed loan-to-value ratio tweaks could bring a few lower deposit holding, higher income earning borrowers out of the woodwork. Additionally, and while it's probably not as influential as credit demand, the sharp turnaround in migration figures is also likely to place additional pressure on property, either through rental or buying demand. Despite one more forecast increase in the official cash rate to come, the likely peak in mortgage interest rates will no doubt leave new borrowers feeling more comfortable about evaluating the worst case scenario for mortgage payments, made clear by the serviceability test rate sitting about 2 percentage points higher than the current rate they secure. Now, I wouldn't overplay this lift in demand by any means, but marginal improvements in confidence have a funny way of leading to material differences when it comes to the property market. Despite any shifts in the market in the short term, expectations remain for a much flatter cycle on the other side of the downturn, due mostly to stretched affordability. The proportion of income required to service an 80% LVR mortgage still sits above 50%, and unless mortgage rates fall dramatically, which is not expected, that's unlikely to reduce anytime soon. For property investors, the likely introduction of debt-to-income restrictions in 2024 and continued phasing out of interest cost deductibility will also limit their numbers. It's becoming harder and harder to justify the costs, especially with the upside of capital growth remaining more constrained. Stretched affordability then will be sure to keep a lid on the number of people able to secure credit, reducing the likelihood of runaway FOMO coming back. You never quite know what's around the corner though, and with the general election now less than 5 months away, economic uncertainty remains. To make sense of it all, make sure to download our free monthly chart pack to stay across the latest property market data and insights. You can access all our news updates on the CoreLogic NZ social channels, including LinkedIn, Instagram, Twitter or Facebook, and subscribe to the New Zealand Property Market Podcast on all good podcast players. Mā te wā.